Right now, at this very moment, there are two prices for silver. One price is real, one price is fake, and if you do not understand the difference in the next 20 minutes, you could lose everything, or you could miss the greatest wealth transfer of our lifetime. Let me show you something that will make your jaw drop. I'm looking at silver prices from around the world right now. COMEX in New York says silver is $103.26, new all-time record high. Sounds great, right? But wait. Dubai silver dealers are selling physical silver at $165 to $170 per ounce. Japanese retail markets are selling physical silver at $145 to $150 per ounce. Shanghai Exchange is clearing physical silver at $135 to $140 per ounce. Same metal, same day, $60 to $70 difference. This has never happened before, not at this scale, not across every continent simultaneously. And here's what the financial media will never tell you. This gap is not closing. It is getting wider every single week. Why? Because the paper silver market is a fraud, and that fraud is about to be exposed. Welcome to the hidden economy. Subscribe now and turn on notifications. And like this video because what I am about to reveal will not be covered anywhere else. Let's go. Here's the first thing you need to understand. The price you see on your phone, on CNBC, on any financial website, that is not the price of silver. That is the price of a promise. COMEX does not trade silver. COMEX trades contracts, pieces of paper that say someone somewhere promises to deliver silver if you ask for it. But here is the dirty secret of the COMEX. For every 1 ounce of real silver sitting in their vaults, there are approximately 300 paper ounces being traded. 300 to 1. This is not conspiracy. This is how futures markets are designed. It is called leverage. It is called fractional reserve trading. And it works perfectly fine as long as nobody actually asks for their silver. But what happens when people start asking? That is exactly what is happening right now, and the system is breaking. In the first 2 weeks of January alone, 33.45 million ounces of silver were physically withdrawn from COMEX vaults. In 7 trading days, 26% of their registered inventory walked out the door. People are done trusting paper. They want metal. And there's not enough metal to go around. Let me give you a number that should terrify every banker in New York. COMEX registered silver inventory right now is around 420 million ounces. Sounds like a lot. But registered does not mean available. Most of that silver is already allocated, already spoken for, already committed. The actual free float, silver that you could actually buy and take delivery of today, some analysts estimate is under 100 million ounces. 100 million ounces for the entire world. Global silver demand last year was 1.24 billion ounces. Global supply was 1.01 billion ounces. That is a 230 million ounce deficit in one single year. The world consumed more than double the available free float in deficit alone. Where is that silver coming from? It is coming from vaults, from stockpiles, from reserves that took decades to build, and those reserves are almost gone. Now let me tell you something that almost nobody knows. China controls the silver market, not partially, completely. China refines approximately 65 to 70% of all silver produced on planet Earth. Every silver mine in Mexico, Peru, Australia, most of that ore gets shipped to China for refining. And on January 1st, 2026, China changed the rules. They reclassified silver from an ordinary commodity to a strategic material, same category as rare earth elements, same category as materials critical for national defense. Now, only 44 companies in all of China are authorized to export silver, and to qualify, these companies must have annual production capacity of at least 80 tons and credit lines above $30 million. Hundreds of smaller refiners who used to supply the global market are now locked out. Before this policy, China exported over 4,000 tons of silver per year. That metal flowed to America, Europe, Japan, everywhere. Now that flow is being choked. And here is what makes this even more interesting. While China is restricting exports to the West, Chinese domestic buyers are panic buying silver at any price. Shanghai premiums over COMEX have been running $8 to $15 per ounce for weeks. China is keeping silver for itself. They see what is coming. They are preparing. The question is, are you? Now let me explain something that will change how you see this entire situation. There is a war happening right now between paper and physical is winning. In a normal market, if silver costs $100 in New York and $160 in Dubai, traders would immediately arbitrage that gap. Buy low in New York, ship to Dubai, sell high, pocket $60 profit. Simple, right? But the arbitrage is not happening. The gap is not closing. It has been there for weeks, and it is getting wider. Why? Because when traders try to take delivery from COMEX, they are discovering there is no silver to deliver. Let me tell you about the delivery reports from January. JP Morgan took massive delivery, thousands of contracts. They are accumulating physical metal as fast as they can. This is the same JP Morgan that paid $920 million in fines in 2020 for manipulating precious metals markets. Now they are flipping from short to long. They are grabbing every ounce they can. What do they know that you do not? Meanwhile, other banks are scrambling. Deutsche Bank delivered large amounts, suggesting they are being forced to come up with metal they probably did not have. The delivery reports read like a battle. Big players fighting over a shrinking pool of real metal, and the retail market is even crazier. In Japan, silver premiums on secondary market platforms have hit 60% above spot at times. People are paying $150, $160 for metal when the screen says 100. In UAE, Pamp Suisse bars are listing at premiums that would have been unthinkable a year ago. In India, which is the world's largest silver importer, buyers are offering $5 to $8 premiums over international prices just to secure metal. The physical market is screaming that silver is worth far more than the paper price suggests. Now, let me tell you about the banks, because this is where it gets really scary. The big bullion banks are short silver, massively short. What does that mean? It means they have sold silver they do not own. They have promised to deliver silver they do not have. They are betting the price goes down. Some estimates suggest Bank of America is short approximately 1 billion ounces of silver. Citibank may be short over 3 billion ounces. Let me put that in perspective. Total global silver production per year is 800 million ounces. That includes everything: solar panels, electronics, jewelry, investment. Everything the world produces in 12 months. Just 2 banks have short positions equal to 5 years of global production. How do you cover that? Where do you find 5 years of supply when the market is already in deficit? You cannot. Not without driving the price to levels that would bankrupt you. This is why the paper price is being suppressed. This is why COMEX keeps raising margin requirements. This is why the system is doing everything possible to prevent a physical delivery squeeze. Because if physical delivery demands overwhelm the system, the banks face catastrophic losses. I'm talking billions, maybe tens of billions, enough to threaten Tier 1 capital ratios, enough to threaten solvency. And here's the kicker. On December 26th, while everyone was enjoying the holidays, the New York Federal Reserve made a $17 billion emergency cash injection to an unnamed bank. $17 billion, emergency, unnamed. Nobody knows who received that money, but the timing is very suspicious. Right in the middle of the silver squeeze, right when delivery demands were spiking. Draw your own conclusions. Now, let me explain some technical indicators that even most silver investors do not understand. Silver lease rates. When someone wants to borrow physical silver, they pay a lease rate. It is like interest on a loan, but for metal. In normal times, silver lease rates are 1% to 2%. Nothing special. In October, when silver first broke above $50, lease rates exploded to 35%. 35%. That tells you how desperate people were to find physical metal. They were paying 35% annualized just to borrow silver for a short period. Even now, lease rates remain elevated at 8% to 9%, far above normal, still signaling severe tightness, backwardation. This is another indicator that almost nobody talks about. In a normal commodity market, future prices are higher than spot prices. This is called contango. It makes sense because storing commodities costs money. But silver is now in backwardation. Spot prices are higher than future prices. Think about what that means. The market is paying more for silver today than for silver 3 months from now. Why would anyone do that? Because they are not confident they can get silver later. They need metal now, and they are willing to pay a premium for certainty. A year ago, silver was in normal contango. Spot around $30, futures around $42. Today, the curve is inverted. Spot around $100, some forward contracts around $73. This inversion is a giant red warning sign. The market does not trust future supply. COMEX registered versus eligible. Most people do not understand this distinction, but it is critical. Registered silver is metal that is available for delivery against futures contracts. This is what matters. Eligible silver is metal sitting in COMEX vaults, but not available for delivery. It is just stored there. The owners have not made it available. Over the past year, registered silver has been collapsing, down nearly 70% from 2020 levels. Meanwhile, eligible has been more stable. People are keeping their silver in the vaults, but they are removing it from the delivery pool. Translation: silver owners do not want to sell at these prices. They are waiting for higher. This shrinking registered pile is what creates delivery squeezes. Less metal available for those demanding delivery. Now, let me tell you about industrial demand, because this is not just about investment. Silver is being consumed, literally eaten by industry. And unlike gold, most industrial silver is gone forever. Solar panels. Every solar panel needs silver for its electrical contacts. The photovoltaic industry consumed over 140 million ounces last year. and solar installations are projected to double in the next 5 years. Electric vehicles. Every EV uses significantly more silver than traditional cars. Electrical systems, batteries, charging infrastructure, all require silver. Artificial intelligence. The explosion of AI requires massive data centers. Those data centers need servers. Those servers need silver in their components. This demand barely existed 5 years ago. 5G networks. The global build-out of 5G requires silver in antennas, base stations, and transmission equipment. Electronics. Smartphones, laptops, tablets, medical devices, military equipment. Silver is everywhere. Here is the critical point. This demand is inelastic. That means these industries need silver regardless of price. Apple cannot decide to make iPhones without silver because the price went up. Tesla cannot make EVs without silver. Solar companies cannot skip the silver in their panels. If silver goes to $200, they still buy it. If silver goes to $500, they still buy it. They pass the cost to consumers, but they still need the metal. Meanwhile, supply cannot respond. 70% of silver comes as a byproduct of mining copper, lead, and zinc. You cannot just mine more silver. You have to mine more copper first, which might produce more silver as a side effect. And opening new mines takes 7 to 10 years. Even if silver hits $500 tomorrow, new supply would not arrive until 2033 or later. Demand is locked in. Supply cannot flex. Inventories are depleting. This is the setup for a historic move. Now let me give you the clear bottom line. The paper price of silver is a fiction. It represents the price of promises that may never be fulfilled. The physical price of silver is reality. It represents what people actually pay to own real metal. Right now, physical is 40 to 70% higher than paper. This gap will close. It has to close. The question is which direction. Either the paper price rises to meet physical reality. Silver goes from 100 to 150, 170, maybe 200 on COMEX. Or the paper market breaks completely. Exchanges declare force majeure. Paper becomes worthless and only physical matters. Either way, owning physical silver appears to be the right position. Now let me tell you some facts that even experienced silver investors do not know. Fact number 1. The London Bullion Market Association, the LBMA, is even more opaque than COMEX. Most people focus on COMEX because it publishes daily data. But the LBMA in London is actually larger and more important for global price discovery. And their data is almost impossible to verify. The LBMA claims to have around 790 million ounces in their vaults. But here is what they do not tell you. Most of that silver is double counted. It is used as collateral for multiple transactions simultaneously. The actual unencumbered silver in London may be a fraction of what they report. And there is no independent audit. You just have to trust them. In November, the LBMA was in such distress that over 1,392 tons of silver had to be shipped from New York to London just to meet delivery demands. That is 44 million ounces in 1 month. Emergency shipments across the Atlantic because London was running dry. And even after those shipments, the situation remains critical. Fact number 2. Silver miners are not increasing production despite record prices. This seems crazy, right? Silver at $100 and miners are not ramping up? But it makes sense when you understand the economics. Most silver comes as a byproduct. Miners make their money from copper or zinc. Silver is just a bonus. They are not going to open new mines just for the silver byproduct. The few primary silver miners that exist are struggling with rising costs. Energy costs, labor costs, equipment costs, regulatory costs. Even at $100, their margins are not as fat as you would think. And here is the kicker. Many miners are hedged. They sold their future production forward at much lower prices. They locked in $50 or $60 silver months ago. So even though spot is at 100, they are not getting 100 for their metal. This means production response to higher prices will be much slower than in previous cycles. Fact number 3. The gold to silver ratio is historically extreme. Right now, gold is around $4,800. Silver is around $100. That is a ratio of 48 to 1. Historically, this ratio has averaged around 50 to 60 to 1 over the past century. But in major precious metals, bull markets, it compresses dramatically. In 1980, the ratio hit 15 to 1. Silver outperformed gold massively. In 2011, the ratio hit 32 to 1. If the ratio compresses to 30 to 1 in this cycle, and gold stays at 4,800, silver would be $160. If the ratio compresses to 20 to 1, silver would be $240. If the ratio hits 15 to 1, like in 1980, silver would be $320. This ratio compression alone, without any additional gains in gold, could more than triple silver from here. Fact number 4. Central banks are secretly accumulating silver. Everyone knows central banks are buying gold. It is in the news constantly. But almost nobody talks about central banks and silver. The reason is most central banks do not officially report silver holdings. It is considered too small and too volatile for reserve status, but that does not mean they are not buying. Reports from Russia indicate strategic silver stockpiling. China's actions clearly show state-level interest in controlling silver. Even smaller nations with mining industries are holding back production for domestic reserves. This is stealth accumulation. It does not show up in official statistics, but it removes metal from the market just the same. Fact number 5. The SLV ETF may not have all the silver it claims. SLV is the largest silver ETF in the world. It claims to hold physical silver backing every share. But read the prospectus carefully. It allows for unallocated silver. It allows for silver held by sub-custodians who may hold silver on behalf of multiple parties. It allows for settlement failures. The prospectus literally says the trust may not have adequate sources of silver to meet redemption demands. In a real crisis, SLV shareholders may find they own a claim on a promise, not actual metal. This is why sophisticated investors are moving from paper ETFs to allocated physical holdings. They want metal with their name on it, not a share of a pool that may or may not exist. Fact number 6. The silver derivatives market dwarfs the physical market. Total above ground silver in the world is estimated at 2 to 3 billion ounces. That includes everything in vaults, jewelry, silverware, industrial inventory, everything. The notional value of silver derivatives is many multiples of that. Some estimates put it at 50 to 100 times the physical supply. This means the derivatives market is not hedging physical silver. It is pure speculation and financial engineering. And when derivatives dwarf the underlying asset this dramatically, it creates instability. Small changes in physical supply or demand can cause massive moves in derivatives, which then feed back into prices. We are seeing this now. The paper market is trying to price silver based on trading flows. But the physical market is saying, no, metal is worth more. The two cannot diverge forever. Fact number 7. India is a wild card that could accelerate everything. India is the world's largest silver importer. Indians have a cultural affinity for silver that goes back thousands of years. Silver jewelry, silver coins, silver religious items. In 2024, India imported record amounts of silver. Demand was so strong they were paying significant premiums over international prices. If Indian demand continues to grow, or if there is a wedding season surge, or if the rupee weakens making silver look attractive, Indian buying alone could tighten global supply dramatically. And India does not have significant domestic silver production. They are entirely dependent on imports. If global supplies tighten further, India will have to compete with China, with industrial users, with investors, for a shrinking pool of available metal. This competition could push prices far higher than current levels. Fact number 8. Military and defense applications for silver are growing. This is rarely discussed, but it is important. Silver has unique properties for military applications: antimicrobial coatings for equipment, electrical contacts for missiles and satellites, specialized batteries for military vehicles, even cloud seeding for weather modification. As geopolitical tensions increase, defense budgets are expanding globally, and modern defense systems require more silver than older technologies. This demand is invisible in civilian statistics, but it is real and growing. Governments do not publish their strategic silver needs for obvious reasons, but when you see countries like China classifying silver as a strategic material, you know defense considerations are part of the calculation. Now, let me give you some practical guidance. If you want to buy silver, understand you will pay a premium over spot. That premium is real. It reflects the actual cost of acquiring physical metal. Do not complain about it. The premium is the market telling you that real metal is worth more than paper promises. Buy from reputable dealers, check their track record, verify they actually have inventory. In a tight market, some dealers sell metal they do not have. Consider your storage. Home storage has risks. Bank-safe deposit boxes have risks. Third-party vaults have risks. Understand the trade-offs and choose what fits your situation. Think about forms of silver. Coins carry higher premiums but are more recognizable. Bars are more cost-efficient but harder to sell in small amounts. 1,000-ounce bars are cheapest per ounce but require serious storage and are hard to liquidate quickly. Avoid paper silver if you want true exposure. ETFs like SLV hold paper claims. Pool accounts are just promises. Futures require you to trust the exchange. In a crisis, paper silver may not track physical. If you already own silver, think about your plan. What price would you sell at? What would you do if prices double? What would you do if prices crash 50%? Having a plan prevents emotional decisions. Most importantly, understand this is a long game. The forces driving silver, supply deficits, industrial demand, monetary debasement, geopolitical conflict, these are structural forces that play out over years. There will be volatility. There will be corrections. There will be days when silver drops $10 and the media declares the rally over. Those who understand the fundamentals will not panic. They will recognize corrections as opportunities. The 1970s silver bull market took almost a decade. There were multiple corrections of 30 to 40% along the way. Those who held through the volatility made life-changing wealth. I believe we are in the early stages of something similar, maybe bigger. $100 silver is not the end. Based on the fundamentals I have shown you, it might be just the beginning. Let me leave you with one final thought. We are witnessing a historic moment. The disconnect between paper and physical markets has never been this extreme. The supply deficit has never been this large. The geopolitical tensions around critical minerals have never been this intense. Something has to give. Either the paper system adapts and prices rise to reflect reality, or the paper system breaks and a new paradigm emerges. Either way, physical silver appears to be one of the most asymmetric opportunities in the financial world right now. Limited downside, potentially explosive upside. Real tangible assets in a world drowning in paper promises. The window may not be open forever. As more people wake up to what is happening, premiums will rise further. Availability will tighten. Eventually, you may not be able to buy physical at any price. That day may come sooner than most people think. If this video opened your eyes, smash that like button. Share it with everyone who needs to understand what is really happening. The mainstream media is not covering this. They do not want you to know. Subscribe to The Hidden Economy for more videos like this. We track the real signals and precious metals, not the fake narratives. Thank you for watching. This is not financial advice. Do your own research, make your own decisions. But whatever you decide, decide quickly. The market is moving fast. I will see you in the next one. Peace.